Okay, so we're gonna let's gonna continue on that the example. Okay, so this is gonna be a long one. So we talk about, let me go to the beginning. We talked about last time, we talked about this spreadsheet approach, right? Um, so we call the spreadsheet approach. Okay, let me. Okay, so this is called the spreadsheet approach. So we have three spreadsheets. This is the first one, the balance sheet spreadsheet, right? You can see here we have a debit column, we have a credit column, right? So and then we have income statement the spreadsheet. Yeah, let me just mute all of you. If you have questions, please just unmute yourself. Okay. Um, so this is the second spreadsheet, income statement spreadsheet, where we have a debit column. Oh, sorry. We have a debit column, we have a credit column, right? So, and then we have the third spreadsheet is the cash flow spreadsheet. Okay, so you have debit column, you have credit column. So in this spreadsheet, cash flow spreadsheet, when we have cash inflow, cash gonna increase, right? So we debit, okay? So when we have cash outflow, we credit, okay? So anything, any impact on cash, okay? So any changes in cash, right? So we're gonna put it here, okay? Put it in this spreadsheet. So what we're trying to do is we're gonna explain, okay? We're gonna fill out the blanks, okay, to explain those, you know, those amounts, right? So for example, those the income statements, and those the changes in the balance sheets, right? In the balance sheets. So we're either gonna debit or credit, okay? So try to explain. In the meantime, whenever those changes affected our cash, then we're gonna put it in the cash flow spreadsheets, either debit or credit. Okay, that tells us, you know, those are cash inflow or cash outflow. Okay, so this is what we're trying to do. Okay, so this is, again, this is spreadsheet approach. We use spreadsheets to try to, you know, include all of those information. Okay, um, so we already started, right? So let me go to the, okay, so we already started with the okay, so we're gonna start we start with the income statement, right? So this is the income statement, the second spreadsheet, and we start from the beginning, right? So we try to explain, you know, the sales revenue, right? When we have sales revenue, so we need a credit, right? So then that related to the cash flow is the cash receipts from customers, right? So then another account affected is what is the accounts receivables. Okay, so that's why we need go back to the first spreadsheet, the balance sheet spreadsheet. We want to look at the accounts receivable. You see, this is the beginning balance, this is the end of balance. That increased by 2. That's why we debit 2. Okay, so we debit 2 to the accounts receivable, we credit 100 to sales revenue, and then we need to debit the cash for 98 for the balance, right? So that's why we debit cash for 98 here. Okay, we write it down. So this is the one journal, okay, called a summary journal, but we write it down in a different, you know, spreadsheets. Okay, so when we debit cash, okay, so that's we have a cash inflow, okay, and that's the revenue related activity. That's why we put it under the operating activities. Okay, so and then we label everything, you know, this is number one, so item number one, right? So item number one and item number one. Okay, so this is item number one. We figured out cash receipts from customers. Okay, and we did this one, right? So we did all of those. We did this. We did this. Okay, so let's work on, let's starting with the depreciation expense. Okay, any questions so far before we start? You guys good? Okay. So let's work on depreciation expense. Depreciation expense is this, right? So you can see that we work in the order of of the income statement, right? So one by one. Okay. So once we're done with the income statement, then we go to balance sheet, try to explain those haven't been explained item yet. Okay. So let's see depreciation. Okay, so depreciation expenses is what? It's a three. It's a three. This is $1 million, right? This is $3 million. When we have depreciation expense, what do we do? The journal. Depreciation expense comes from the adjusting journal, right? We usually debit depreciation expense for three, and we credit accumulated depreciation for three. That should be the summary journal, right? So that's why we debit here, we debit three, right? To the depreciation expenses, we label it this number 6, and we credit accumulated depreciation. This cumulative depreciation is on the balance sheet, right? So accumulated depreciation, we find out we need to credit 3, right, to this accounts, okay? And this is item number 6. Okay, so this item has no impact on cash flow, right? So you can see, if you look at the summary journal, there's no impact on cash flow. Okay, this is the item number 6. And item number 7, just feel free to ask me a question if you have any question. Okay, so feel free to stop me. Okay, item number 7. So bonds interest expense. Okay, so it's just 5, right? $5 million interest expense, the bond interest expense. Okay, so remember when we recognize bond interest expense, we issue bonds, right, to borrow money from many investors. Then we have bonds payable, right? And then periodically every 6 months, okay, we're gonna pay interest, right? So we're gonna pay interest. So we call that interest expense. We're gonna make a cash payment, right? But then remember when we pay interest, there is another item might be affected by this interest, okay, by the interest. It's what we call the discount or premium, okay? When we issue bond at discount, those discount will be amortized over those years, right? So periodically, right? So we're gonna decrease the discount, right? Then increase the interest expense, right? And similarly, if we have a premium, then the premium will decrease. Then our total interest expense will be will decrease, right? So the discount gonna increase the expense, right? So when I talk about amortization, and amortization of premium gonna decrease the expense, right? So so then that's the related accounts, okay? So first thing we're gonna do is when we have bond interest expense, we always debit, right? We debit expense, okay? Debit bond interest expense, and then we're gonna go back to the balance sheet to see if we have a discount or we have premium, okay? So in this case, we have a discount. Okay, we have a discount on bonds payable. It was 3. Okay, now it become 1, right? 60 we amortized over the year by 2, right? The 2 is amortized, right? So amortization of a discount. So then we need to what do we do? We need to credit, right? We need to credit this discount on bonds payable. Okay, that's the amortizations. Okay, remember initial balance, the normal balance of discount and bonds payable should be what? Should be the debit column, debit balance, right? Debit balance. Okay, so now it's decreased by 2. That's why we credit. Okay, so then the journal will be what? The total journal going to be debit the interest expense, which is the previous one. What we have? 5, right? So bond interest expense is 5. Okay, we debit 5, and then the discount and bond payable we need to credit, right? The discount on bond payable credit by 2. Then the cash payments should be the balance, which is what? Which is 3. Okay, which is 3. That makes sense. So this is the cash payment. This is the cash payment for the interest, right? So this is what? This is the cash outflow related to our interest expense, which belong to the operating, right? Operating are those revenue expense related activities, cash flow activities. So this cash outflow, we need to go to the cash flow spreadsheets. We put it under the operating activities, okay? And the operating activity to this. So we need to credit 3, okay? We need to credit 3 to cash, okay? So this is the cash outflow. We call that cash outflow to the bondholders. This is item number 7. Any questions for this one? You good, right? For this bonds. Okay, and another one here is the number 8 here is the insurance expense. Okay, insurance expense. For the insurance expense, the related item is the prepaid insurance, right? Remember when we make payments, we usually record it as prepaid expenses, and then by the end of the year, we're gonna make adjusting journal, recognize those insurance expense. Okay, so those are the those related accounts, it's insurance expense and the prepaid insurance. Okay, so when we have insurance expense, we always debit, right? So debit insurance expense. Okay, so we label this item number 8. Okay, we debit insurance expense, and then we're gonna go to the balance sheet to look at the information about the prepaid insurance, right? So prepaid insurance here was 6. Now by the end of the year was 3. Okay, it becomes 3. It decreased by 3. So this is the assets decrease. That's why we credit. Okay, assets decrease. We need to credit. Okay, so let me write down the whole. Just make it visually looks like better, right? So if I write down everything together, so I don't have to write this journal, okay? But because you look at this spreadsheet, you already see it, right? But I put it together, so we have insurance expense, which is 7, right? And then this prepaid insurance, because it decreased, that's why we credit prepaid insurance decreased by 3. That's why we credit 3. And then cash payments here should be the balance, right? Which should be 4, right? Should be 4. This is a cash payment for the insurance. Okay, cash payment for the insurance. So, and this is insurance expenses related cash outflow, right? So that it belongs to the operating. Okay, so we go to the cash flow spreadsheets. This is the cash outflow, right? We credit 4, okay, to the cash. And this is the item number 8. We call that cash outflow for the insurance expense. Okay. So next one is the loss on sales of equipment. Okay. Loss on sales of equipment. This one is we need the information. We call it additional information B. Okay. This is additional information B. Okay, so let me show you the additional information. By the way, additional information was posted on Canvas, right? So if you need to look at that, but let me share the additional information here. This is the one, right? This is the one. Okay, additional information. Actually, the whole sheet is the whole information. Okay, so we have the balance sheets. So we have balance sheets here, and then the balance sheets from here to here all the way, and then we have income statement, right? So from here to here, okay? So those are already on the spreadsheets. And now we have this, right? This is the additional information, okay? So we need this additional information. So, so this is additional information B, which is this, right? B said equipment that originally cost 14 millions, and which was 1/2 depreciated, was sold for $5 million cash. Okay. Okay, let me just mute you guys. Okay. So again, if you have a question, just unmute yourself and ask me a question. Okay. Um, so so look at this information. Okay. So equipment that originally cost 14 millions, which was 1/2 depreciated, was sold for $5 million cash. Okay. So if you look at this information, the journal should be what? You sold for $5 million cash. We should debit cash, right? We receive cash for 5 millions. Okay. And then equipment original cost was 14. So we had equipment, we have this, we have these two accounts, right? So we have this equipment accounts, and then we have this accumulated depreciation accounts, right? The equipment account original cost was 14, right? So we should have this account, okay, with balance 14. And it's at 1/2 depreciated. That means accumulated depreciation should be 7, right? 1/2 of depreciated, okay? So now we sold this equipment, we let it go, right? So we let those two accounts go, okay? So what we're gonna do is we're gonna debit 7, right, to accumulated depreciation. We debit 7, we credit that the equipment, okay, for 14, okay, and then we have this so-called loss. Why we have loss? You can see here the book value is 7, right? But we sold it only for 5. Okay, that's why we have this $2 million loss. Okay, this should be the summary journals. Okay, this should be summary journal regarding this situation. Everyone's okay with that, right? So everyone's okay, right? So then we're gonna go back to the PowerPoints to write the summary journals, okay, in the spreadsheets, okay? So we have this loss on sales, that's why we debit, right? So remember debit 2, okay? Loss on sales, debit 2, and then we need to go back to the balance sheets. So we have equipment accounts, right? This is equipment accounts. We sold, right? We sold those, so that's why we credit, right? Credit 14 is item number 9, okay? We credit 14, and how about cumulative depreciation? We need to debit 7, right? Debit 7, okay? And then we have a cash, right? So we need to debit cash for 5, right? So remember what kind of activity it is? We need to go to the cash flow spreadsheets. We debit 5. So this is what? This is our internal investing, right? So internal investing, okay? So we need to debit 5 under the investing activities, okay? And the investing activities. So, and this is item number 9, okay? So you call that sales of equipment. We have cash inflow. You guys okay, right? Okay, that's
Yes.
okay, that's great. And the income tax expense, okay? So income tax expense is 9, right? Was 9. So then we have cash flow, right? So you cash paid for the income tax, okay? So that's related, right? And also normally we may have that income tax payable, okay? Income tax payable are affected, okay? So when we have income tax expenses, we debit, right? That's where we debit 9. And then you go to the balance sheets, look at the income tax payable, see the income tax payable, it was 8 at the beginning of the year, by the end of the year was 6, okay? So it's decreased by 2. Liability decrease, we need to debit, right? So that's what, let me write it down. Again, that's, I don't have to write it here, but just look at, just let you visually look at this better. So we should debit income tax payable for 2, okay? And we debit that income tax expense for 9, okay, and then we credit cash for the total, which is 11, okay, this is 11 total, okay. So this is the cash outflow related to our expense, right, which belong to the operating, okay, that's what belong to the operating. So we credit 11, okay, to cash. So this is item number 10, and this is cash outflow for income taxes. Okay, so that's item number 10. The last item is the net income. Okay, so net income. Remember when we have net income, net income will be close to retained earnings. Okay, so when we have net income, our retained earnings are gonna increase. Okay, so what we're gonna do is we debit net income. Okay, for 12. Okay, again, this is not a real journal. Okay, this is just summary journal. Just help us to figure out the cash flow. Okay, so we debit 12 to net income, and then we credit retained earning for 12. Okay, so that should be the summary journal, right? Debit net income. I don't write any that one. Okay, that's too simple. Debit net income for 12, credit retained earning for 12, because net income increase retained earnings. Okay, so that's item number. Sorry, that's item number 11. Okay, item number 11. Okay, so this is the one we talk about. So this is and then right now right now everything is done with the income statement. Right, you can see here we successfully explain all of the items in income statements. Right, all of the items in income statements, okay, was successfully explained. Okay, and we either have debit or the credit. Okay, so try to explain. And now we're done with income statement. We fully explained. Now we go back to the balance sheets. Okay, so we try to explain those items. Okay, we haven't explained yet. So we try to finish. Okay, let's start from the bottom, from the beginning. Okay, from the top. Okay, to the bottom. Then we go down to the bottom. Okay, so we don't explain cash. Okay, so the cash will be explained the last. Okay, because we talk about the cash flow. Okay, so let's explain. Let's look at the accounts receivable. Accounts receivable already explained, right? Okay, accounts receivable already. Let me just list these parts. Accounts receivable already explained, right? So in item number 1, right? So 30s increase 32 with debit, right? Which is good, right? And short-term investment, we haven't explained this yet, right? It was 0 at the beginning, 0 beginning. By the end of the year is 12. Okay, so what happened to that? This is the additional information C. Okay, so we need to work on it, right? So what happens with this? That's why we try to figure out those information related to that cash flow. Okay, so we found the information. Let me go to the additional information. Okay, so let me just erase this part. So additional information C, as you can see, let me just read those one quickly. Okay, C said the common shares of another company were purchased for $12 million as a short-term investment. Okay, so basically we made an investment, right? So we purchased another company's stock. Okay, so we spent 12 million, right? We purchased another company's stock. Okay, So as a short-term investment. So if you look at this, see here, the journal should be what? Should be short-term investment, right? 12. Okay, this is the one of the assets. Okay, current asset account, and we pay with the cash, which is 12, right? So this should be the summary journal. Okay, relate to this information. So once we know that, then we go back to the balance sheet spreadsheet. Okay, so go back to the balance sheet spreadsheet. What we do is we debit, right? So as we talk about here, we just fill out that summary journal in the spreadsheet. We debit 12, right? Debit 12, okay, to the short-term investment, and we credit 12 to cash. So then remember, credit 12 to cash, we always, when we debit credit to cash, we always go to the cash flow spreadsheet, right? Cash flow spreadsheet. Okay, the cash flow spreadsheet, we credit 12. Okay, we credit 12 to cash. Okay, for purchase of short-term investment. So this is what this is our investing activity, right? This is external investing activities, right? We making investment. Okay, so that's why we put it under the investing activities. Okay, investing activities. And this is cash outflow, right? Because we need to credit, and this is the item number 12. Okay, so go back to the balance sheets. So we're done with the short term. Now, how about the inventory? Okay, inventory was explained already, right? Because beginning was 50, by the end of 46, we already item number 4 already credit 4, right? To explain the change. Okay, so we're done with inventory. How about the prepaid insurance? We're done, right? Item number 8 already explained. Okay, the decrease of 3, right? And how about the land here? Land, we did partial, right? Okay, explain. Okay, so explain partially. Okay, so that's item number 3. Then we should have, it's not, you won't, when you do, just if you don't look at the item 13 here, okay, so you won't be able to see, it's not fully explained. Okay, because the land was 60, now it's 80. Okay, so then there's something. Okay, so then that's why we need to dig. Okay, we need to figure it out, try to explore the information. So then we have that information, additional information, which is D. Okay, so let me show you the additional information. Okay, additional information D is that property were purchased for 30 million cash. Okay, for use as a parking lot. Okay, for use as a parking lot. So that's a D. Okay, so if you look at this situation, what the journal should be, we should debit the land for 30s, right? We credit the cash for 30. Okay, so that should be the summary journal. Okay, so then go back to the spreadsheets. Go back to the spreadsheets. We have this 30s, right? To debit, right? So debit 30s, okay, to land. Okay, debit 30 to land, and this is item number 13. Okay, so once we debit 30 to the land, now we can explain the differences, right? You can see here it was 60, now increased by 30, decreased by 10. By the end, it is 80s, which is good, right? So we fully explained. So again, this summary journal should be we're gonna debit 30 to the land and we credit cash, right? So we're gonna go to the cash flow spreadsheet. We credit cash for 30s. Okay, remember this is a credit column, right? So we credit cash to 30s. So this is the item number 13. Okay, and this is what? This is our investing, right? This is the internal investing. Is that right? We purchase these long-term assets. Okay, it's an internal investing. That's why it belongs to the investing activities. Okay, we put it under the investing activities. So we're done with the land. How about buildings and equipment? Okay, so buildings and equipment, we just partially explain. Okay, so not fully explained yet. So we need to dig on that, right? So so that should be additional information E. Okay, E. Okay, so let me show you the additional information E. Then I know this is very lengthy, okay, the example, okay, but we're almost there, okay. So this is E, right? If you look at the E here, said new equipment was acquired by issuing 12% 5-year, 20 million notes payable to the seller, okay. So we put in new equipment, okay, we sign the notes to promise pay them later, right? So look at this information. So we know the summary journal for this should be with like this: debit equipment for 20 millions, right? We credit notes payable for 20 millions. That makes sense, everyone? Okay, so this is non-cash activities, right? Non-cash activity, but we still need to go back to the spreadsheet to fill out, okay, to fully explain, okay, the changes. So we like this, right? So we debit 20, okay. So here we debit 20 to the building and equipment, right? Okay, and we credit notes payable for 20, okay. So that's the summary journal, okay. And we label this item number 14, okay. Item number 14. Everyone's okay so far? Okay. So once we have this, then you can double check, right, to see if we fully explained. So 75, right, beginning balance plus 20 minus 14. So we got 81, right? So which is correct, okay? So we fully explained that. And then how about accumulated depreciation? We already explained, right? We fully explained that, okay? So 20, okay, minus 7 plus 3, you got the 16, right? So which is correct, okay? So so we're done with all of the asset sections. Now let's work on the liabilities, okay? So we fully explained the asset, right? So now let's work on the liabilities, starting with accounts payable. Accounts payable we already explained, right? It was 20. Now it increased by 6, right? So it was 26, which is we done, right? Salary payable, it was 1. They increased by 2. Now balance at the end should be 3. We explained, okay? Income tax payable, we done, okay? Notes payable, we also just finished, right? So it's item number 14. And the bonds payable, okay? Bonds payable, we haven't finished yet, okay? So it was 50, now by the end it's 35. So we need to dig on that, right, to see what happens. So this is additional information F, okay? Additional information F. Let me show you the information. Okay. The additional information F said on January 1st, 2011, so the 15 millions of bonds were retired at maturity. You understand, right? Retired maturity by the end. So we just pay off, right? So when we pay off, what do? We decrease the bonds payable for 15, and we decrease cash for 15, right? That should be the summary journal. Okay, so then we're gonna write it down, right? The summary journal on the spreadsheets, okay, on the spreadsheets. So we gonna the okay, we're gonna debit 15, right? So this is item number 15. We debit 15 to bond payable, okay, and then we need to credit cash, right? Credit cash for 15. Go to the cash flow spreadsheet. We credit cash, okay, for 15. It's the item number 15. Okay, and this belongs to the financing activity, right? So we borrow money, remember that, right? So we borrow money by issuing bonds. Now we just pay off. So this is the financing activity. Okay. Just mute your just mute your guys. Okay. So again, if you any questions, just feel free to unmute yourself and talk to me. Okay. So okay, go back to the balance sheets. Okay, so we're done with the bonds payable. We're done with this discount on bonds payable, right? We're already done. Okay, only work on that bonds interest, right? So now we're done with liability section. Now let's work on the shareholders equity section. Okay, so shareholders equity section. The first item is the common stock, right? Common stock. Okay, so it's 100. Then by the end of the year, it's 130. Okay, so we need to work on it, right, to see what happens. Okay, so this is the additional information. Let's see, additional information G. Okay, additional information G. So let me go to that additional information. Okay, G said here said increase in common stock accounts, right? You can see that you saw the increase in the balance sheet, right? It's attributable to the issuance of 10% stock dividends. Okay, it totally 1 million shares, and the subsequent sales of 2 million shares of common stock. Okay, and the market price of this $10 par value common stock was 13 per share on the date of both transactions. So here we have two transactions, right? Two transactions. One is the stock dividends. Okay, one is the stock dividends. Remember, the stock dividend is 10%. Stock dividend is less than 20%, right? Which we treat it as the real real dividends. Okay, when we have a real dividend, we decrease our retained earnings, right? So that's why we have these journals. So we debit retained earnings for 13, right? Because what? Because $13, 13 per share, that's the price, right? That's the market price for each share. Total is 1 million shares. That's why it's total 13 million, right? Total value of those stock dividends 13 millions. Okay, and then we issue 1 million shares, right? So we issue 1 million shares. We need to credit common stock 1 million times 10, right? 10, right? This is the par value, right? So each share has a $10 par value. Total par value is $10 million. And then we have that paid in capital in excess of par value, right? So for 3. Okay, so this should be the first, okay, summary journals. Okay, and then we don't have a second summary journal for those stock issuance, right? We subsequently issue 2 million shares. Okay, so 2 million, when we issue those 2 million shares, we receive cash, right? How much we receive? 2 million times 13, right? Per shares. Okay. Total is 26. We receive 26. Okay. So again, this is the 13 times 2. Okay. And then we issue stock. Okay. So our total paid in capital going to increase by 26. But we need to look at the par value, right? So this is what? This is 2 million shares. Each shares $10 par value. Total par value going to increase by 20. Okay, and then we have that paid in capital in excess of par value for 6, right? For the difference. Okay, so now we have two. Everyone's okay, right, with that? So we talk about that really in detail in chapter 18, right? So we have these two journals, right? Two summary journals. Okay. So let me go back. Everyone's okay, right? Let me go back to that. We're just gonna write it down on the spreadsheets. Okay, I'll write down the spreadsheets. So so the first journal, we're gonna debit 13, right? this is the item number 16, okay? Debit 13 to retained earnings, okay? We need to credit 10 to common stock and credit 3 to the additional paid-in capital, okay? Or paid-in capital except par value, okay? So that's the first journal. Second journal, we need to credit common stock for 20, okay? Because we issue stock, right? Credit for 20 and credit additional paid-in capital for 6, and then we debit cash for 26. Debit cash for 26, we go to the cash flow spreadsheet. We debit the cash for 26. Okay, 26. And this belongs to the financing activity, right? Because we issue stock, right? To get financing. This is the financing activity. This is the item number 17. Okay, so we done with common stock, we explained. We also explained the paid-in capital was 20, right? So now increased by 9, so it's 29, which is good, right? So now look at the retained earnings, okay? We haven't fully explained retained earnings yet, okay? So we need to look at the additional information H, okay, to see the impact on the retained earnings, okay? Additional information H said cash dividend of 5 million were paid to shareholders. We paid dividends, right? We paid dividends. So what is the journals for the dividends we paid? We're gonna debit retained earnings, right? Credit cash, okay? I don't need to write down, right? But let me just write down, okay? So we need to debit retained earnings for 5 and the credit cash for 5. This is a dividend journals, okay? So then we're gonna write it down on the spreadsheet, okay? So we're gonna debit retained earnings for 5. Oh wait, come, I can write it down here, okay? Okay, I'm gonna write it down the 5, right? Debit 5 to retained earnings and credit cash, okay? Credit cash, go to the cash flow spreadsheet, credit cash for 5, okay? This is the credit, okay? This is item number 18, and this is financing activities, okay? So basically we explained, we're done, right? So we've done every items here, okay? And then if you want to look at the last item, the cash here, this is, we just trying to explain, right? So we need to debit cash, okay? So because 20 to 29, we need to debit cash, and then this is gonna be here, okay? We credit 9 here, okay? So just fulfill, okay? Fulfill the exchanges, okay? So now we're done, okay? We fully explained the income statement, the change, the item in the income statement, and fully explained the changes in the balance sheets, okay? So now we just go look at this third spreadsheet, the cash flow spreadsheets, and look at those debit and credit, right? So remember, all the debit credit are to the cash, okay? So when we have debit to the cash, this is the cash inflow. When we have a credit to the cash, this is have cash outflow, okay? And then we're just trying to rewrite this part, okay, to make it clear, okay? So remember, not debit credit, okay, anymore. We just think about cash inflow, cash outflow, okay? Again, debit should inflow, credit should be outflow. So this is a formal cash flow statement, okay? This is the formal cash flow statement. You can see here, right? So from operating, we have cash inflow, those two inflow, or previously it was debit, right? So then we have those cash outflow was credit, right? So we just rewrite, okay? Rewrite this. This is the total, okay, from operating, and then the investing, this is the total, right? Financing is the total, and all of these three number together is total is 9, right? And 9 plus 20, you got 29. Okay, so that's all. Okay, basically. Any question?
What is the journal entry for number 19?
19 is debit cash and the credit cash. The same thing here, okay?
Oh, so both
Yeah, debit cash
cash.
and credit cash for 9. Okay. Any other question?
Is this the method that's most commonly used to prepare the statement of cash flow?
Yes, that's right. This measure should be used. We don't usually we don't want I don't want you to use the T account anymore. Okay. When you use T account, it's very basic. Okay. When you in the earlier time when you learn this accounting, you use T accounts. Okay, to figure out the cash flow. It's better way is this: is you use summary journal entries to figure out those items. Okay. And then this is called the spreadsheet approach. We use that approach to gonna include all of the items. Then you don't make mistake, right? You can see that all of the items was explained, right? Were explained to get this cash flow. So we do have several homework questions regarding like this. Okay, so but I don't think we have that much time to work on it during class. So we just work on a simple questions. Let me let me show you. Where's the question? Oh, here. Okay. We're just gonna work on this relatively simple question. This. Okay. So let's work on this. This is the question. E20. What? E21-25. Okay. Let's work on this. E21-25. So this is just for operating activity only. Okay, just try to save our time. Okay.